If you handed me $1,000 or $10,000 or even $100,000 right now, I wouldn't invest it all the same way, especially going into 2026. Because the truth is, the strategy for investing $1,000 should look completely different from investing $100,000. One of the biggest mistakes that people make is trying to copy strategies from wealthy investors when they're working with completely different levels of capital. So today, I'm going to show you exactly how I would invest each amount, the reasoning behind every move, and the mistakes that I would avoid at all costs. Before we start, I want to make something clear. This video is not for you if you're looking for something magical with an easy button to make $100,000 overnight. But if you're someone who is willing to work hard, try new things, and fail forward, then this video is definitely for you. You can do all the things I mentioned, or maybe just one of them, depending on your lifestyle and what you already have going on. And of course, none of this is financial advice. This is just simply for educational purposes based on what I would personally do. And make sure you stick around until the end, because the $100,000 strategy is actually where most people make their biggest investing mistake. And it can cost them years of progress. All right, let's break it down. With $1,000 in 2026, your goal isn't to chase massive returns. Your goal is to build a foundation. In the grand scheme of investing, $1,000 is not a lot of money. And that's actually why I wouldn't immediately rush into dumping into stocks, hoping that it would magically turn into $100,000. Instead, the highest return investment at this level is usually yourself. If I had $1,000 starting from scratch, I would seriously consider investing that money into learning a new skill or expanding a skill I already have. Maybe that's a trade, maybe that's a certification, maybe that's learning something like sales, marketing, coding, editing, or real estate. Something that has the potential to increase your income. Because here's what most people don't realize. Increasing your income by $10,000 per year is way more powerful than earning 7% on $1,000 in the stock market. For example, when I first got into real estate, I paid $997 for a course. At that time, that felt like a lot of money to me because I didn't have much money. But that knowledge helped me learn how to find deals, how to negotiate, and eventually how to invest in real estate. That one investment has probably returned me over 1,000 times what I paid for it, if not maybe even more. And that's the power of investing in yourself. Now, with that said, if you don't want to invest the entire $1,000 into education, here's another strategy I personally like, and that's flipping items for profit. With $1,000, you can easily start buying items for $200 to $500 and reselling them for $650 or more. Some of the easiest items to flip are couches, furniture, appliances, yard sale finds, garage sale items, Facebook Marketplace deals. Many people are just trying to get rid of stuff quickly, which creates opportunities. If you can consistently buy things below market value, you can create small profits that add up quickly. And while you're doing this, I would keep the money sitting in a high yield savings account. This way, your money is still earning interest while you're working on flipping more items and growing that capital. Even if it's only a few percent, it's still money working for you. At the 1,000 level, the goal is simple. Build momentum, learn something, make mistakes, grow the money, because once you reach the next level, things start getting more interesting. Now, before we move on to the $10,000 level, let's talk about the biggest mistakes people make when they start with $1,000. The first mistake is trying to get rich too fast. People throw their money into random crypto coins, meme stocks, or whatever is trending on social media. They're hoping that $1,000 magically turns into $100,000 overnight. But the reality is most of those bets end up going to zero. The second mistake is doing nothing at all. A lot of people keep waiting for the perfect time to start investing. But the truth is, the best investment at this level is simply getting started and learning how money works. Even if you lose a little bit early on, the lessons that you learn will be worth far more than $1,000 itself. And the third mistake is underestimating the power of small wins. If you can turn $1,000 into $2,000 or $3,000 consistently, that skill can scale, because the same strategy that works with $1,000 will eventually work with $10,000 or even $100,000. Now, with $10,000, things start to change. This is where you can actually begin building real momentum. But at this level, structure becomes extremely important. If you still haven't invested in yourself yet, this might be the right time to do it. I would probably allocate $2,000 to $3,000 towards learning something that can increase that income even more. But at this stage, the key is to choose something that can pay for itself within 1 to 2 months. That means something practical, something applicable, something that generates income. Now, if you've already invested in yourself and you're ready to invest the full $10,000, here's how I would personally allocate it. First, 40% into index funds. This could be things like Vanguard Total Stock Market ETF, so it's under VTI ticker, Vanguard S&P 500 ETF, VOO ticker, Schwab Dividend Equity Fund, SCHD ticker. And these funds give you exposure to hundreds of companies instantly. Instead of trying to pick the perfect stock, you're letting the entire market work for you. These also pay dividends, which means the companies are literally paying you for owning shares. And the key here is reinvesting those dividends. Don't spend them, let them compound. And next, I would allocate 40% towards flipping bigger items. Now that you have more capital, you can flip higher value items. This may include nicer furnitures, appliances, maybe even used cars. But the key here is to do research before buying. Understand the market value first, because when you buy the right items, the profit is already built into the deal. Next, I would allocate 15% towards individual stocks, but only top tier companies. We're talking about companies like Apple, Microsoft, Nvidia, Google, Meta, companies that have dominant positions in their industries. And it doesn't have to be entirely tech. That's just what I'm more familiar with. What I would not choose is chase hype stocks or meme coins. That's how people lose money. Then I would allocate 5% towards asymmetric bets. This could be crypto, innovative technology, or even a side business experiment. For me personally, that would be Bitcoin and Ethereum. But I keep it small because these are higher risk investments. At the $10,000 level, protecting your downside becomes just as important as growing your upside. Another thing that I would focus on at this stage is networking. Connecting with other people who are doing what you want to do. For example, if you're interested in real estate, start meeting with local investors. There's a ton of local investor groups that you can easily join. Build relationships. Find people who have good reputation and proven track records. Because eventually, once you build enough capital, you might even be able to lend money on these deals. For example, if you eventually grow your capital to $50,000, you might lend $30,000 to an investor doing a rehab. Typically, these loans pay anywhere from 8 to 12% interest over just a few months. But of course, this requires proper protection like promissory notes, deed of trust, legal agreements. There are risks involved, but there's also real opportunities. And often those opportunities come from relationships. Here's some mistakes that people make with $10,000. Now, when people reach the $10,000 level, a completely different set of mistakes start to appear. The first mistake is overconfidence. They make a few successful trades with flips, then suddenly they're thinking they're the next Warren Buffett. So they start taking bigger risks and concentrating their money into one single investment. And that's dangerous because if that investment goes wrong, you can lose a huge chunk of your capital overnight. The second mistake is chasing trends. Maybe it's the latest hot stock, the newest crypto coin, or whatever's blown up on TikTok. By the time that most people hear about those opportunities, their early money has already been made. And the last mistake is not building a network. At this level, relationships become extremely valuable because the best deals, the best partnerships, and the best opportunities usually don't show up on Google. They come from people that you know and trust. That's why surrounding yourself with other motivated people can help accelerate your growth faster than any other investment strategy. Now, once you reach 6 figures, everything changes. At this stage, you're not just trying to make money anymore. Now you're trying to build real wealth. And that means focusing on assets that produce long-term growth and income. Here's how I would personally allocate $100,000. First, 40% into real estate. You guys already know that I'm a big believer in real estate. With $40,000, you could potentially fund a down payment on a rental property, a BRRRR strategy deal, or even a rehab on a flip. And going into, come here. And going into 2026, if interest rates continue improving, we may start seeing more deals come back into the market. Real estate has several advantages. You get appreciation, rental income, tax benefits, and leverage. Next, 20% into index funds like VTI, VOO, or SCHD. This becomes the core of your long-term portfolio. The goal here is consistency. Let the market compound over decades, then I would allocate 10% into maybe Bitcoin or Ethereum. Doesn't have to be that specifically, not as a gamble, but as a long-term hedge and growth asset. Because you never know, if this thing takes off, then you've at least got some stake in it. Next, 10% into bonds or treasury bills. These provide stability and predictable returns, especially during volatile markets. Then 10% into individual blue chip stocks. But I would limit this to maybe 5 to 7 companies maximum, quality over quantity with this. And finally, 10% kept in cash or an opportunity fund. This is extremely important because when markets crash or opportunities appear, the people who have cash available are the ones who can move quickly. 6 figures is where discipline matters more than excitement. Once people hit the 6-figure investment level, the mistakes become even more expensive. The first mistake is getting bored with safe investments. Index funds, rental properties, and blue chip stocks may not feel exciting, but historically, those are the assets that quietly build the majority of long-term wealth. People sometimes abandon these strategies because they want something more exciting and they're bored. And that's when they start gambling. The second mistake is going all in on one opportunity. Even if it looks like a great deal, putting all $100,000 into one single investment creates massive risk. Diversification protects you from unexpected events. And the third mistake is not keeping liquidity. A lot of investors deployed every dollar that they have. But the truth is, the biggest opportunities often appear when markets are down or when other people run out of cash. And the investors who still have liquidity are the ones who can buy assets at the best prices. And the biggest takeaway here is this: your strategy should always change depending on how much capital you're working with. At $1,000, the focus is learning and building momentum. At $10,000, it's about creating structure and stacking opportunities. And once you reach $100,000, the game becomes protecting capital while letting long-term assets grow. Because wealth usually isn't built from one lucky investment. It's built from consistent decisions made over many years.